You're not in this role, especially with founders, to take the limelight. You're here to propel. I mean, I talk about it as at service leadership. Like, you're at the service of the founder. You're at the service of the executive. Like, the finance leader is to elevate everybody in the company to make better decisions, to achieve what they need to with the resources that we have, and similarly with the board. And so you've got to kind of have that mindset with founders.
Is this thing on?
Yesterday's price is not today's price.
Hey everybody, welcome back to the podcast. What follows is a conversation between me and Curt Sigfstead, the CFO of Clio, a vertical software provider to legal firms. Yes, they're one of the most popular and successful privately held vertical software companies out there on the market today. And more importantly, everybody's been asking for it. Stock-based comp. SBC, baby. We go deep. Half of this episode is purely on employee equity. His take on share-based comp. Is it real? Why was it ignored for so long? And the evolution of share types as an organization gets bigger. You move from the left, where it's the most liquid, to kind of formats that look more and more like cash. And how finance leaders should budget for equity compensation. This is tactical when they're doing their annual and long range planning. We haven't dug into this with anybody yet. It's awesome. And we talk about how CFOs can explain the potential value of equity to prospective hires. You're going to want to bring a pencil to this one. I wrote it down. It's sitting right in front of me. He has this framework of how he explains equity to potential hires to sell them on the firm. And we also touch on how to work with founders, how CFOs can forge a great relationship with founders, and also unblock roads for them in areas that may not be their strong suit. All this and much, much more after a short word from our sponsors. Being an operator is not for the faint of heart. It often feels like you're jumping out of an airplane and building the parachute on your way down. CEOs, CFOs, COOs, and BizOps leaders feel my pain. That's why I joined Operators Guild. It's home to more than 1,000 of the most elite, high-growth operators in the world. Think the Special Forces for business scale. Members have access to over 150 in-person events across all 25 global chapters. The modern startup founder, CFO, and COO are really just multidisciplinary problem solvers, which is why having the best problem solvers together has created the ultimate diversity intelligence of any operator group in the world. Operators Guild gave me the chance to meet my own personal board of directors, people I can bounce ideas off of, and their online forum allows you to get answers from your peers as questions pop up. Like, how do I run an employee secondary? Or what should I pay as a base commission rate on SaaS deals? I've made great friends through attending their highly acclaimed OG Summit and frequently attend their online masterclasses taught by the best tech operators in the business. Join Operators Guild and access the Navy SEALs of high-growth business scaling, a group built by operators for operators. Learn more and apply at operators-guild.com. That's operators-guild.com, and tell them CJ sent you. They'll hook you up. Annual planning season is upon us. That's right, my favorite time of year. And it's not just about setting goals for the coming year. It's about ensuring you have the right tools in place to measure and achieve those goals. As a SaaS CFO, I know having access to reliable, real-time metrics is crucial for my annual planning process. That's why I'm so excited to partner with today's sponsor, Maxio. Maxio is a billing and financial operations platform that helps subscription businesses reconcile bookings, billings, GAAP revenue, and SaaS metrics automatically. By the way, guys, bookings, billings, GAAP revenue, not the same thing. Got to get them straight. Because these numbers are the foundation of your financial models, it's important to have quick access and trust that they are correct. Don't let the complexities of SaaS finance and accounting slow you down. If you want to start 2025 with the right tools, check out Maxio by visiting maxio.com/run the numbers. That's maxio.com/run the numbers. Request a demo through our link to support the podcast, ya boy, and receive a 10% discount on your first year with Maxio. That's maxio.com/run the numbers. maxio.com/run the numbers. Please, guys, I really need this. Curt, thanks for joining me on the podcast.
Great to be here, CJ.
Like I told you before we started, I'm a huge fan of Clio and what you've built in the vertical software space for legal companies. And I think we're going to have a lot of fun topics to dig into here.
Yeah, no, I'm looking forward to it. There's a lot to dig into, a lot of similarities, it sounds like, in terms of some of the work you've been doing, and happy to provide a perspective on the topic. So yeah, let's jump in.
So we're going to talk about first this mythical creature. It's something of folklore. Some claim it exists, and they've actually seen it, and others actually deny its existence. It's something called stock-based compensation. So what's your take? Is it real? Break it down for us.
Yeah, it's absolutely real. It's one of those aspects of comp, and it's a very complex aspect of financial planning and preparation and discussion with the board, in the sense that a lot of folks don't see it until they really want to see it. And, we get companies who are issuing stock-based compensation as part of their total comp plans. There's always the struggle in terms of communicating that value, which we can dig into, to employees as an important part of their compensation. And it's incredibly important to the board with respect to, and I'm talking about a venture-backed company, and typically the investors form the board, as to how they think about how their equity and their investment is being diluted, but in a good way, because they're benefiting from the work and the effort of all the employees of the company. From an employee standpoint, it is real when the IPO happens or when the company is sold, and all of us, or there's a secondary, as we're seeing more and more now, especially in later stage tech companies. And, they can buy their house, they can buy that car, or create those savings accounts for their children to go to college. It has real consequences, but the initial landing of it and discussion and explanation of it is often challenging. And that's where I think we're getting at in terms of, like, is it real and when is it real?
Yeah. Well, why was it ignored for so long? Because if we go back 5 years ago, like SBC was not an acronym that was thrown around a lot.
No, there's been a very interesting evolution on this front. And I really do believe it's one of these topics that does swing depending on the nature of the market and the nature of the company specifically. And so what we saw, throughout, call it the pre-COVID period from 2010 to 2020, was companies consistently growing, hitting their numbers, lots of expansion of multiple, a lot of value creation, not one peep about stock-based comp.
No.
There was a few, but, hey, everything's going right. So why rock the boat? And then you get into COVID and there's a lot of stuff happening. There's hyper growth. The value of money is virtually zero. And we're in this very, I think, temporal environment. And we come out of it. And there's sort of the reckoning. And as investors started to really dig into what their returns were now going to be, they really had to start to figure in the amount of dilution that was now being presented to them as part of employee compensation. And, I think in fairness, there's a lot of support for what investors, talking from a company standpoint, there's a lot of fairness in terms of how investors were coming at this issue, because it had gotten pretty substantial in a number of companies relative to their revenue. SPC as a percent of revenue had gotten up to north of 20%, which, is a big number. And, yearly dilution, north of 10%, which, was just, I think, something that was hitting people harder as stocks were falling. And that has come back, that sentiment or those concerns have, they're now in the private markets, and they're all around, they're late stage companies like Clio. We talk a lot about it. It's part of our annual planning process, and we'll get into that. But it's something front and center. And I do fundamentally believe CFOs and companies need to be very prepared on their philosophy around this and why they're doing what they're doing and what is the impact to the investor as a result. It's important to take that into account. So
that helps a lot.
But I do perceive if we start growing again, this may not be an issue.
Yeah. It's similar to what I say with sales and expenses. Like, a lot of revenue cures a lot of sins. It can go the same way for stock-based comp to a certain extent. But I mean, you were saying for some companies, it was getting up to like 20% of revenue. I mean, at scale, a rough benchmark is companies will have 30% of their revenue in sales and marketing, or you may have, 20% in R&D. So this was like adding a whole nother department to burden the P&L with.
Yeah, exactly. Which is, this gets back to our, your initial sort of entry to the conversation, which is like, is it real? And this, this manifests itself in the P&L, not like just employees and like, is it real? It's like, is this a real expense? And, I think for a lot of period, again, going back to those 10 years, it was just a non-cash expense that was backed out, in terms of, whether the company was EPS positive or not, but it wasn't part of the conversation. But it is really an expense. This is something that, when those options are exercised or those RSUs are part of the share count, there's real dilution, and therefore the returns to the other investors are not there. And I think we saw actually a number of recently public companies take some real criticism, especially from activist investors around, I think of Twilio, for example. There was a lot of chatter around their stock-based comp as a percent of revenue, and activists were making a big deal about it. But I don't doubt that there was probably a lot of thought given as to why there was that much comp driven. There's, the other set of the conversation is like, well, maybe we need to preserve cash, or maybe we need to get to cash flow break even faster.
I'm so glad you brought that up. I actually didn't think of that. Like, it's the other side of the coin. Maybe you were trying to level out for something.
Yeah. And so management is always trying to optimize in some way. Like, believe me, these decisions, as we all know, and you know this role, all these decisions are taken with a lot of thought and consideration and otherwise. And there may have been decisions around trying to optimize for reducing cash burn. So let's give more equity. There's more, there's sort of more leverage on the employee to perform, and they're more aligned with the company. And that's a great thing, what we believe. But then it manifests itself in dilution. And, that can be, the other side of the coin, which is the issue that investors focus on. So.
And do you think the criticism is exactly the same for private versus public companies when it comes to share-based comp, or is there a nuance based on what stage you are?
I think there's a little bit more latitude the earlier stage you are. And I think that's because, at least my view on this is because a lot of conversations in earlier stage companies is about what percent of the company do I get, especially around executives as they join. And so it's like, okay, well, we are giving out a lot of stock-based comp because we have to attract the talent to give us the leverage we need to drive the company forward. As you become a more, call it mature private company later stage, I think there's much more line of sight to the public markets, and therefore total comp becomes more, the sort of norm. You're talking about cash, variable, and then equity comp. And that has to start to align with the public markets, or at least there has to be a bridge as you're sort of looking forward, because you're going to enter the public markets, perhaps, maybe not, but you're starting to think that way. And you can't enter with like this sort of compensation model that investors can really get access to because it's all public, that's completely out of line with your other public comps. So, earlier stage is different. There's less comparability. You need to give out more equity because you're attracting people. Late stage, you got to align with the public markets.
That totally makes sense. And to take a step back, you've been a part of organizations that have had amazing growth paths, but there are different flavors or formats of stock-based comp, right? So what's usually the transition or the mechanism in which you reward employees with equity?
Well, this is a topic we debate a lot at Clio. And, I think, traditionally, as we've all talked to, we'd all probably all agree, options, RSUs, public equity, it's kind of like, it's pretty straightforward. But there are public companies that still grant options. It's not, as part of their compensation plan. So I think that there's a couple of different factors. I think one is what the company has traditionally done and where they are. And two is where they are in the stage of their growth and what makes most sense. Three is sensitivity to dilution. So, what the interesting thing is like typically, in the way we think about it here at Clio, is to effectively grant, the fair value of an option. You have to grant almost 2 options for each share. Like if you think about it that way, because you grant an option, it has its strike price. So the employee has to pay the strike price to get, access to the value that is in excess of that strike price. So you're really telling the employee that, they're going to get 2, 3, 4 times X or, whatever. And we'll talk about that, kind of how to frame that. But when you grant the equity, it's theirs, like an RSU or a share, it's theirs. Like that, there's no question, like they don't have to exercise it. There's no cash out of their pocket to do so. It's there. And so you can get a lot less dilution out of a unit of a RSU versus an option, typically, especially in late stage, because you don't have the multiplier effect on the options. So, I think that's an overview. And then, you get into founder thinking, and you have to be very aware of your founders' areas of focus. And, I've worked with founders where options are important. They want to see that opportunity for the employees to really lever themselves into creating wealth, and and sort of puts a little bit different flavor in the game, even in a late stage company, relative to granting them shares.
Oh, got it.
Like an option profile, like you typically have the 1-year cliff and then the 4 years.
Yeah.
But the equity you get right away. Like there's things you can put in place to, to waterfall that too, but they get that equity.
Right. Well, there are different types of equity.
Yeah.
Would you say on the spectrum, they get closer and closer to being cash rewards or bonuses at the end of the day?
Pretty close. Yeah. And I think that's where I say some founders have some challenges with that, given what they're trying to accomplish with, growing the company. And
exactly.
But at the same time, you'll hear, recruiting teams and managers say, well, I'm trying to get someone from Amazon, or I'm trying to get someone from Microsoft, and this is what they do. And they're not able to effectively translate or equate what we're trying to do with options with effectively this liquid stock that Amazon can provide.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Ready to take your company global? Mr. Worldwide! You'll expand your business into new countries, hire international team members, run multi-currency payroll, pay local benefits, and stay on the straight and narrow with tax compliance. Sounds like easy stuff, right? As businesses grow beyond their borders, they face a maze of regulations and logistical challenges. RemoFirst clears the path as your trusted global employer of record, enabling you to hire in over 180 countries without setting up local entities. They manage international payroll, tax compliance, and HR benefits while ensuring adherence to local employment laws in every country. Whether you're looking to make your first international hire or streamline existing global operations, RemoFirst makes global employment simple with their employer of record EOR service starting at $199 a month, an average of 50% less than other providers. I've seen companies grow their operations in 20 countries with RemoFirst help. You can get 2 months free on EOR fees for your first hire in any country by visiting remofirst.com/metrics. That's REMOFIRST.com/metrics. Discover how easy international hiring can be at remofirst.com/metrics. Just go to remofirst.com/metrics. As a startup CFO, the number one question my friends come to me with is, who do you use for banking? That's right. They don't ask me for my chicken parm recipe, and they don't ask me where I got my dog groomed. I'm the friend they come to for invoicing, credit card, and bank account advice. Go figure. So I thought I'd just come out and answer it for everybody on the podcast. I recently made the switch to Mercury because I was losing my mind trying to get a clear understanding of how cash entered and left the building. Financial operations were getting needlessly complex, and that's coming from someone who does finance stuff for a living. You can't manage what you can't measure, so I made the change. Plus, it took me literally under 10 minutes to go from application to approval. I'm not kidding. It was wild. Mercury simplifies your financial operations with powerful banking, and it gives you greater control, precision, and speed so you can operate at your best. Mercury is a financial technology company, not a bank. Banking services provided by the Choice Financial Group and Evolve Banking Trust. Members FDIC. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks. And I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. I'm so glad you brought that up. So let's actually transition to that. How do you as a CFO explain the potential value of equity to prospective hires in a way that's both balanced and realistic while also creating excitement? Like you should join us.
Yeah. So, in my seat, I'm typically brought in sort of director and above level, depending on the nature of the questions and conversation. And I actually don't start with like the value. I start with our mission, and I start with a TAM conversation. I start with like, let's take it out a little bit here. Like, let's talk about Clio and what's this opportunity ahead of us? Because I want them to really understand that, for us, and at least the way we see the world, there's so much opportunity. And it's really about us executing as opposed to us worrying about, company X doing something or the fact that the TAM is limited. So I start there and talk about the operating model and how we've been focused, over in terms of growth and profitability and the fact that we have a fairly substantial cash balance and no debt. So kind of like just take down the oxygen or take down the pressure in the room on like, what's going on? Like, is this a company? Because there was a lot of folks, I think, burned during COVID around companies that where the equity collapsed because business models were perhaps a little bit more speculative. And that's fine. Like that was, that's what happens with the innovation economy. But just kind of take that sort of white elephant out of the room and then get into how we value, our equity, 409A, where that stands relative to, and I think there's sort of relative to the last preferred round. That's typically how some CFOs explain it is like there's, look, your equity's priced this relative to where investors just put their mark on the company. And then two, talk about kind of what has happened over the company's financing history. Now, every CFO has to sell in the best way possible. So you can't, sometimes you have down rounds and sometimes you don't, but, so you got to do your best. But the way we're fortunate at Clio is, just talking about the fact that like, this is where we did Series B, Series C, D, E, and now F that we just contemplated. And if you sort of look at that historically, we've been able to accomplish this and we've had a consistent, growth rate over that period with respect to our revenues. And so you can get some comfort that as long as you believe this TAM is as big as it is and we're the leader in the marketplace, that this, it's up to us, which is why we give you this equity as you're part of the team to execute against that to create the value.
This is the inside baseball that people come to the pod for. So thank you. And to play it back, chapter 1, go through the TAM. This is the big stinking opportunity in front of us that you're joining.
Exactly. Yeah.
Number 2, here's the business model of how we're going to go about it. By the way, it's a pretty great business model. It's very solid. We have cash. Number 3, here's how we value that business model through equity. And number 4, here's the history. And then it allows the person to almost make the mental jump themselves to, wow, okay, so I can be a part of this.
Yes, exactly. And it also gives them, I think, I think the underlying aspect of it is, wow, these people think about it in a very logical way. And I like joining companies that think about things logically. So
right.
Anyway.
That was great. And then how do you talk to the organization about the value of the company's equity? What are the key points to get across during one of these information sessions? And congrats, by the way. I imagine you had to do some sort of information session with the most recent round you raised.
Yeah, no, thank you on that. We can talk about that in a little bit more detail. But we're actually very consistent with external parties as much as we are with our internal employees around talking about value of options and the potential upside. I think, I think if we were sort of getting to a place where we're, our disclosure is different, we run into problems in terms of if those employees join, the information they didn't have, those prospective employees versus what employees have. and what we can actually disclose as a company, because all the stuff that we're using to value equity and talk about our opportunity, I feel very comfortable talking to a prospective employee about. So we don't hold regular updates on value or talk about it, very openly as a company. But what we do is we have a very clear description of how we value our equity, how our employees should think about options, the value of options, what options are, just explaining all that on our Confluence page so that everybody can reference it internally. Yeah. So it's very, very clear. Anyone can go there anytime. They can reach out to myself or members of my team on the finance side. And two is they have access to Carta. We use Carta as our equity platform, and that shows them what the value is of their equity and how that's changed with respect to how we're, changing our 409A, which we do now twice a year. And they can see how that has trended over time and, see that value accretion.
This may be a really in the weeds question. So you do it twice a year. Is the standard that you have to do it at least once?
I don't think there's any standard.
Oh, all right.
So, and what I mean by that is I think it really depends on the stage of company, the available resources, and how close you're getting to potentially a public exit, because you want to have that backup as you're, approaching the public markets and then pricing your common stock. And I think what, some investors run into is, a company does the financing and then does another one 3 years later, but hasn't updated the company, the employee equity since the last financing. And that creates a bit of friction in terms of like, wait a second, like, there's a big difference here in terms of where the equity's been issued and where we're going to pay, to invest in the company. So we do it just to keep, I think it's good housekeeping for us now.
Keep it fresh.
Keep it fresh.
Okay. And something that you also do at least once a year is budgeting. Do you go into budgeting with a percentage in mind? Like, hey, this is the equity burn that we expect as an org, and then you push it down to the department? Or how does someone even go about it? Because a lot of finance people out there know I have this limited option pool. I know really well how to do my P&L when it comes to like headcount and expenses, but like, how do I go about budgeting for the option pool?
Yeah, so we do a bottoms up and tops down. And so the tops down is, there's a lot of external benchmarks. There's a lot of opinions that board members have based on benchmarks or other companies they're working with. And, that ends up in a range depending on, the size of company or stage that you're at. It could be as low as 2%. And it's also based on growth rate, very importantly, because the number of employees you're going to be adding, over the years. So I've seen it as wide as 2 to 8%. 8% is probably out of bounds for a lot of company now, and sort of more kind of in that 4 to 5 or 3 to 4%, now if you sort of late stage venture backed company as a percent of outstanding shares. So that's kind of like high level. So then how do you then, okay, that's great, but we have to know if that actually works. So what we do on a bottoms up is post our budget sort of planning cycle ending, which then we know exactly what we're going to, well, there will be more people to hire, I'm sure, but we have a really good idea of what we're going to be hiring over the next 12 months. We do a bottoms up plan on because we identify obviously by level, department, everything like that, what the total comp package is, because we've got, all the data from Compensia, Radford, Pave, all those folks. And you just build it bottoms up, and then you have an idea based on the employees you're going to hire, like how much equity do we need? And I think that's a great check to do. It's something we implemented when I got here at Clio, because I think this is like great, but what if those two don't match? There could be reasons for that based on, we're hiring a lot more employees than, the average company. We're just growing faster. Or two, there may be a number of executive hires that you're going to make in the next 12 months that are really outside of like a normal hiring cycle, and you've got to make some additional room for that. So that may end up adding an extra, depending on the role, like 0.25% to 1%, depending. And so you've got to build that into that range. And that's why that range is so wide in some respects. And so anyway, it's both a bottoms up and tops down approach, at least here at Clio on that front.
That's a great explanation. And do orgs eventually become mature enough where you can push down essentially like a budget envelope of equity to department leaders? Is that like the North Star, or does it usually always just sit with the finance department to divvy it up?
So I do think you can get an organization to a place where you can push down the equity allocation to, leadership in more the departmental base, as opposed to, at your C team or your S team level only.
Yeah.
So yeah, that can happen. And we do that through Workday, and we can help them kind of allocate it. And so we have guidelines, like here's what your employees would expect, especially as they're going through promotion or progression cycles. What's the additional equity for the base that's here? I think the hiring is pretty straightforward. That's not, everyone knows what they got to do, but it's that progression piece and promotion, which we also build as part of our plan, from the bottoms up. And, we give a range, and they can decide that they want to put some more against someone versus less against another, based on even some employees want more cash than they do equity, and they indicate that to your manager. And so we want to give the manager, I guess, a sandbox to work in, but some decision-making capability. Yeah.
Yeah. Like, here's the toolkit you have. You can pull from these different levers. What I have seen organizations do is they get mature enough to do the new hire equity grant budgeting, and they're not just shooting at the hip anymore, but then they forget about the refreshers and top-ups for existing employees, which also dilutes the cap table.
Yeah. Yeah. That's an important one to get right. And, we just looked at based at historical data and what percent tends to be promoted. And it's a forecast. It's meant to give us some comfort, but it's never perfect.
Maybe the last question and a celebratory point on equity in the cap table. So you just raised around this year. Can you take me through that process and provide some color?
Yeah, sure. I'll try and keep it brief, CJ. We started this process in December of 23. And we wrapped up everything with our announcement in July of 24. We started with an idea that we would raise somewhere in the neighborhood of 300 to 400 million. We hadn't raised any capital or provided any employee liquidity since early in 2021, and then the round before that was in 2019. So it was the right time to go to market. And we started that process, Jack and I, about 18 months before that, actually going to conferences, starting to familiarize investors with the legal tech space, how we were talking about our business, talking to more growth-oriented investors and crossovers, a lot of PE firms as well, because they have growth funds associated with their, asset complex now. And then, Gen AI hit, right? And legal tech kind of was thrust into this spotlight early in, 23. And so that whole process of interest and understanding started to accelerate. And so when we got to, December of 23, when we decided to go to market, there was a lot of folks who were eager to hear our story and a little bit more, I think, primed to understand legal tech and Gen AI. So that's sort of the background. And I do believe as a company, you do need to be active with investors before you go to market. You got to have a good sense of who gets your story, who doesn't, because you can't invite everybody into your process. And the size of check, like there are a lot of funds that just don't have, the capacity to do what you want to do. And you got to quickly weed those folks out, because there's a lot of folks who will do $10 to $30 million checks, but that's not what you're in the business of doing at this scale. So that's number one. Number two is a tremendous amount of preparation on financial modeling, all the metrics, the forecast, and importantly, which I think we talked about earlier in the preparation, hitting our numbers during the process. So how do we, make sure that we are best positioned to never disappoint as we're going through this process? So a lot of work on that front. So, typical measure 5,000 times and cut once. you gotta, because you only get, it's kind of like when you put all the models and the presentation and everything in the data room, it's It's like that now you've got all the world's best investors poring over your data, looking for inconsistencies and issues. Went through that whole process, started meeting with investors in March. The prep process probably took us 2.5, 3 months. Then, our initial meetings took us, that took about 2 or 3 weeks. We had, presentation went through. And then it was the process of narrowing down the group, but also starting to understand that folks were interested in more equity and wanted to invest more, and that dialogue starting, and then how we would incorporate that into our process. And then, basically getting down to, the great folks who invested in Clio and nailing the term sheets and all the documentation around that, which that's a complex process at a late stage company with large amounts of capital being committed by these organizations and their desire for parity, for information, for protections, all those types of things. And so some of the conversations are tough. Like, this is all negotiation, but we landed it in exactly where we wanted it. We got a fantastic group of investors: NEA, Goldman Sachs, Sixth Street, Tidemark, and Capital G all came in, and with obviously JMI and TCV, who are also investors. And then we also have T Rowe and Omers as well. So we've got a great group of folks who really help us move things forward. But yeah, we got that done. And then, the other complex part, and every CFO who goes through this understands it, is the employee liquidity piece of it. And the education, jurisdictions. We have multiple jurisdictions. We have employees in Europe and Ireland, Canada, US. Ireland has very different tax withholding relative to the US, relative to Canada. You've got to get all that right. Tremendous amount of internal management on that front. And there's not one platform that does that well. It's very difficult to manage. Like, that's a business opportunity in my mind. But because I think 90% of this happens, or 80% of it happens in the US only. And so, there's platforms that do that well. But when it gets to multi-jurisdictional, it's tough.
That was an amazing walkthrough. Thank you for that. I want to transition a bit to talking about working with founders, working with the board, and being transparent as a CFO. And you as the CFO, you're often in this position where you're working directly with founders through situations that founders may not have navigated before. And in fact, they may have only worked for themselves their whole life, particularly when it comes to financial planning, compensation planning, and capital markets. Are there any strategies for working with founders and empowering them from the CFO seat?
Yeah, there's a couple. One is take your ego and put it in the bottom drawer and shut it hard. And really listen and build trust. I found that founders are an incredible source of information, and they have very compelling perspectives on business decision making, whether it's compensation to new products. But you got to find a way to get it out. And you've got to ask the right set of questions. And it's got to be Q&A based and conversation based, because the best way I've found is founders have almost an allergic reaction to the answer no. Like, so, take a conversation. You're saying like, no, you shouldn't do it that way, like as a CFO. Okay, well, that just set off an alarm bell, and that ends up, creating all kinds of friction as you continue to go through the conversation with the founder, as opposed to help me understand. Let's get to the bottom. What are you really trying to do? What are you trying to do? Have you thought about maybe approaching it from this perspective, because it would, add this, this, and this? Or is that an issue? You do have to really think about how you're going to approach these issues, because the founder has to see you as an ally and has to trust you implicitly. And 3 is, you're not in this role, especially with founders, to take the limelight. You're here to propel. I talk about it as at service leadership. Like, you're at the service of the founder. You're at the service of the executive. Like, the finance leader is to elevate everybody in the company to make better decisions, to achieve what they need to with the resources that we have. And similarly with the board. And so you've got to kind of have that mindset with founders. And I can tell you, just avoid a lot of challenges if you adopt that.
I like how you said put your ego in the bottom drawer, because a lot of CFOs come into it like, I have all the business answers, but then you have to think about it more dynamically. Like, where is this company competitively positioned? What are we trying to bring to market? And also, I mean, founders just seem to have a good gut instinct, and sometimes you may not know why they're saying something, but like you said, it's Q&A. You have to get it out of them.
Yeah, I think as CFOs, we have to implicitly understand this business. I'm in this role because this founder created this company. So let's just like make that clear in our minds that the reason why we're here is because of this individual, and this individual has managed to create X number of jobs through seeing an opportunity that somebody else didn't. So exactly to your point, CJ, like they have great instincts. Like they didn't get here because they didn't have good business skills. They just, in effect, delivered a lot of that implicitly because of they knew what they wanted to do, and they had, sort of a vision to do that. So it's really important to listen to founders and
Sure.
get it, that perspective out of them.
And founders also come with a lot of optimism. That's why we follow a lot of them, because we believe in the vision. At the same time, though, CFO, chief truth teller, sometimes you got to call the baby ugly. How do you balance working with a founder that's the eternal optimist in times when maybe everything isn't going splendid, or there are things you have to improve upon?
I think there's sort of a couple. This is, I'm very fortunate in this situation in that, I'm very aligned with the CEO. Jack's fantastic to work with on these types of topics. And I really think what you have to start with the founder is like, look, we need to provide you with the maximum flexibility possibly. So start with that, like that you're not coming at them with these ideas that it's to constrict, their ability to invest, their ability to grow, that you're coming to it from the seat of, I want to ensure that you have the maximum amount of opportunity. So let's look at where things are working and where things, are not, because we got to focus. Like we can't have the leaky bucket while you're spending all this effort and time on the growth aspects of the business. And because that's going to catch up with us in a really bad way and eventually constrict your ability to do what you want to do. So it's really just, I think about frameworks from the perspective of the founder. And so I found that to be effective. And then of course, you got to go into the issues around, okay, so what is it? Is it, our sales efficiency? Is it our product velocity? Is it our employee turnover? Like what is it that is not giving? Is it, concerns over hitting targets that are too rosy? Like, what do we need to do to make sure that you continue to have the maximum amount of flexibility? It's really a mindset.
That's amazing, because you're pitching it to them as an opportunity and optionality. You're not shutting it down as like, thou shall not do this.
No, I think that's one of the biggest mistakes CFOs can make. I
Sure.
think most of us get it in the private world and in the venture-backed world that that's the way things operate. But it's really important that you don't come in as a know-it-all and full of your own self-ego and believe that you have all the answers, because there's some things that you just may not know that the founder wants to drive towards, or there may be conversations going on between a board member and the founder that you're just not a part of. And so, approach everything with that growth mindset and to get your issues heard. Otherwise, if you come in and say, look, you got 10 problems, buddy, and there's big issues on the horizon, like 99% of founders will just shut down on that.
Yeah.
And you're left alone.
Right.
To solve those problems.
You never want to fail alone either.
Yeah, exactly.
You'd brought up this concept of filling the trust battery, and I love that visual of that. Is that with board members when you come in? What does that refer to?
I think of it as everyone you work with at the company. You've got this trust battery that you're filling up, and sometimes you're draining based on, sometimes you don't get to things or there's a challenge or whatever. But you're trying to maximize that, or to ensure that you've got enough trust, available to you to do what you want to do. And where I see that in, sort of, let's pick one specific example, is you're presenting a budget to the board, and you've got some initiatives that are going to take you off your operating model, perhaps that you've committed to or you're talking about. Well, just be very transparent about like, okay, so if we did these three, if we did this initiative or this initiative, this is the impact on our rule of, this is our impact on our rule of this. So just, where would you, but we could see our growth, accelerate, or it may not have any impact on growth because it's more of a 2000, it's impact us in a couple of years. I think just being transparent about what you're trying to do is a big part of building trust with folks. And it goes to working with the founders and with your executive team. Just the transparency is a big part of that trust. And because your job is not to, it's to invite board members in, it's to invite others to participate in the process. It's not to hold them, at a distance and keep them out of the kitchen, if you will.
I like that. It's inviting people in and it's not creating a wall.
Yeah, friction. Yeah, and a wall. And
well, part of that trust battery with investors starts when you're fundraising and giving them a plan and saying, hey, look, this is what we plan to do. We're going to do it. Can you go deeper into the importance of meeting and beating your numbers during a fundraise?
Yeah. So, kind of related to this trust and transparency piece, your fundraising process isn't necessarily all about capital. What you're selling effectively is whether or not you can be trusted. So investors will get the model, they're going to get the TAM. They, in fact, they do a lot of that work even before the process starts because they're obviously interested in the space. And so then it comes down to the management team and the execution history and also the progress of execution through the process as to whether or not I need to discount the forecast that management's provided me by 5% or 30%, and they all discount those forecasts. Like we know that. That's why we put together all the detail that we do to support them.
But on that point, Curt, do you think there is a bit of gamemanship that goes on behind the scenes where like everybody puts 10% up in their plan because they know they're going to get discounted 10% down? Or is that dangerous to think into because then you may not hit the plan?
Well, I think what you have to do, I think you do have a responsibility as a company to put your best foot forward. That's what your board, but it has to be a supportable and achievable best foot forward. So the resources have to be in place. The execution has to be, you have to connect the dots. It has to be believable. Your management team has to buy into it. So yeah, it's a strong plan. It's not an unbelievable plan. I think that just puts you in a really bad position because eventually through the process, smart investors are going to smell that out and they're just going to back away because they'll really, they can't trust you at that point. So I think you've got to put something forward that is, puts the company in the best light, but it's got to be absolutely achievable. And that starts with, those forecasts and the plan as you go through the process and achieving those numbers and beating them. And, if you can, or if you miss, being very clear about why you missed and why that's temporary or not, or business has changed. I don't think it's great to hit all your numbers and beat them, but sometimes business, like the environment changes or something happens. And as long as you're very transparent about, okay, this is what happened in the business, but like the core fundamental piece of the business is still intact. And this is what's doing. Maybe we were late on product X launch, and that's why the results are a little bit lower.
It's based on logic, like a reasonable person would.
Yeah. I think sometimes as CFOs, we forget that some of these investors have been part of like hundreds of companies, or at least, a couple of dozen. And they've seen this before. And what they appreciate is teams that are very upfront about what the problem is, and 2, whether it's fixable, and 3, what is that solution and what is the timing for that to be fixed? That they just want to know that your hands are on the steering wheel and you're driving this bus forward, and that you've got their best interests in mind.
Curt, I had a friend who was in the midst of fundraising recently, and he said, CJ, I have this board plan. I'm just going to make up a number here. He said, we're supposed to hit 100 million this year. I've obviously over deployed quota to be able to overachieve that. Let's say I have 120 on the street. And people internally have plans to overachieve that. So I'm feeling really good about the board plan. I'm fundraising. Should I give the people I'm fundraising my board plan of 100, or should I give them the more optimistic plan that I hope to hit?
You got to give the plan that I'm going to say is your board plan, because that's the number that you're going to be comped on as a management team. And that question is going to come up during the process. And they're going to say, okay, well, how many times have you hit that 120 number in this example? If I go back over the last 20 quarters or 2 years or whatever the number is. And if your answer is going to be, well, we're always at about a 20% discount, then they're going to take that 120 and they're going to say, okay, well, then we'll just build that 20% discount in. But if you put a budget number forward and you have a history of beating it by 2 or 3%, there's much more likelihood they'll give you full value for that board or budget plan.
And I ask because there is this human incentive to look at it and say, well, if I tell them now that it's 120 and it's a 10x multiple, that's $200 more million they'll put in the valuation for us at 10x. But then, like you said, you kind of dug your own grave of you said you were going to hit this. Now your comp plan's based on it. So you can't be short-sighted. Yeah.
You have to remember you're selling a portion of the company, not the entire company. And so you're going to be living with these people now for potentially a long time. So the worst way to start a relationship is with misinformation.
It's like you're building a house and you're inviting them to come live in it. When they get there, they find out the AC is broken.
That's exactly right. It's kind of.
I just made that up. I don't know if that makes any sense.
It works. It's a great analogy. I love it.
Curt, I'm going to take you into what we call our long ass lightning round. So you're a successful guy, but I ask every CFO on the podcast, give me an example of something you've screwed up in your career. Could be this role or a different one.
Well, when my first part of career was investment banking. I was not a finance person before going to business school. And I was doing a summer internship at JP Morgan. And I was asked to go and put together a strategy presentation for the shipping industry. Obviously something that I had no background in. And I got it totally wrong. And the MD stood up and threw the presentation across the room and
physically threw it, Curt?
Threw it. Didn't hit me. It wasn't against me. It was this is just you don't know anything. Who are you? Blah, blah, blah. It was sort of in the days back then when, MDs could be a bit harsher. And I felt terrible, but I really screwed up because what I didn't do. And this is something that happens early, I think, in careers and finance is I didn't talk to people. I didn't go out. I kind of went to my cubicle. I was like, okay, here's all the information I can get from, libraries. I put it all together, but I could have gone to the VP who was, doing the shipping stuff, or read the analyst, gone down and talked to the analyst, which you could do at that point, and just sort of got a perspective. And it was a big screw up, but it was a big learning, which is expand the conversation. Yeah. Don't just focus on the data, because you need perspectives, because that's what's going to happen in the room.
I've tried to do that too. I'm like, I'm smart enough. I'll just make the math. When it's I should have just went and talked to someone who knew it. Yeah.
We all go through this, I think, at some point in our careers, but that was a key learning for me. Was, to your point, it's not necessarily about the math. It's about the conversation that's going to happen with the math.
You mentioned you did 20 years in investment banking. What did you learn during that grind about managing the demands of this role, but also being present for your family?
So there's a funny debate in our family, because my spouse often comments about how absent I was from the kids' lives. I just wasn't around. I was traveling with clients, whatever. But recently we had this conversation, because my kids are now out of college, and they're like, oh, we don't remember Dad being gone that much. We remember this, we remember that, we remember this. And what it taught me was, it wasn't about the absolute amount of time. It was the very punctuated situations where we created incredible memories. And that's what they remember. It's sort of like the camping trip we had ice cream tasting for 8 hours. And of course that was I was balled out for that. But the kids loved it, and they remember it. They're like, yeah, we remember that camping trip, whatever. So that's, what I learned about it is, it's not about time. It's about being present for those periods when you can be. And I think all of us as CFOs go through this. We're trying to manage a whole series of demands on our time. And when you're there, be present. That's what people remember. And that's what sort of what my experience has taught me.
I love that. Because there's also such a thing as being there, but not being there.
Oh, it's like you got your phone in your face. You're kind of like, yeah, what'd you say? Like, because your head's off thinking about like the budget you got to deliver to your board or like this. And it's like, no, just be there.
If you could tell your younger self something, knowing what you know today, what would you tell him?
It's an interesting question for me. What I learned, and this is, making the transition from banking to becoming a CFO is there's never an optimal time. There's just the right time. And that transitions take place in your career. I started early in my career with, after the first 2 years, you do this, 3 years. And it's kind of like what happens in investment banking. You kind of go through your career progression. But in terms of the question I often get asked about the transition to becoming a CFO is like, well, you wish you had done it earlier. And the answer is yes, I do actually. Like, I really have found a lot more joy in this role, but it wasn't the right time. Like, but I got a ton out of working, and I love JP Morgan. It's a great institution and I, great friends, but it happened for a reason at the right time. And so in some respects, it's more, I would just tell my younger self is like, just be a little bit more patient at times, and things will unfold, and take the opportunity at that time. And it's okay if it's 2 years early or 2 years late relative to your plan. It's kind of like when you have kids. Kids never arrive when optimal. It's like, we're going to have a family. And it's like, let's go. Like, let's do it.
Yeah.
And so anyway, that's the piece I would tell my younger self.
That's good. Timing is everything, but it's also nothing because you can't control it.
Yeah, exactly.
All right. More of a technical one. Can you walk me through your finance software stack? What tools does your team use to get the job done?
So we have a pretty typical combination of Workiva, Flowcast, NetSuite, sort of as part of our reporting stack. We also have Audit Board. The one tool we're really excited about, which we've just implemented, is Pigment.
Oh, I've heard the name a lot lately.
Yeah, it's been a real game changer for us on the FP&A side. So we had used another tool, and it had not worked very well. And so we were back on, Google, we're a Google shop. So we were back on Google Sheets and Excel, but we've just found a lot of benefit from using Pigment. That has been fantastic.
Nice.
We're going through the typical addition of additional stuff as we mature as a company. For example, we just wrapped up implementation of Coupa, and we'll add stuff as we go forward. So
nice. It's a good stack. Last one I got for you, a fun one. What's the craziest thing you've ever had someone try to expense?
Wardrobes. Yeah. That's one I think CFOs get. Someone gets trapped somewhere. They're there for work. Suitcase gets dislocated. I couldn't go to work if I didn't have clothes. And so, I've had that. That's the craziest thing. It's pretty easy to sort of have the conversation that, just buy, you got to cover those expenses.
And don't buy the Air Jordans.
That's right. Or the Calvin Klein suit that you never had one before. So
right, show up looking like my cousin Vinny.
Yeah, exactly. So anyway.
Cool. Curt, this has been a pleasure. This podcast was a blast for me, and I appreciate you being so generous with your time.
No, thank you, CJ. This has been great. Appreciate your time and the opportunity to share the stories and some of the insights we've had at Clio.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.